welcome to the deep dive. Today, we're putting on our investigative hats
We are.
because a tiny little detail in a financial filing might have some pretty big implications for one of the most exciting growth stories in the world.
A huge one.
We're zooming in on MayTech Global Investments. They're a massive institutional player.
And on a very high-profile stock sale they just made.
Exactly. The specific target of this maneuver was MercadoLibre, ticker MELI. I mean, they're the undisputed e-commerce and fintech powerhouse of Latin America.
Right. So when a fund the size of MayTech trims a winner like that, you have to ask the question.
You really do. Is this a warning sign? Is the magic fading? Or is it just smart, high-level portfolio hygiene?
And that's our mission for this deep dive, to get beyond that headline and find the why.
Okay, so before we jump in, maybe give us some foundational context. What are we actually looking at here?
Sure. So when we talk about these kinds of sales, we're almost always talking about a 13F filing. It's basically a quarterly report that these big institutional managers in the U.S. have to file.
It's where they have to show their hand, so to speak.
Exactly. It's a moment of financial transparency. And a change in a position, as they call it, is never an accident. It's a strategic decision.
Yeah.
And often that decision says more about the fund's internal structure than it does about the company itself.
And that's the key distinction we need to make for you. Is this a verdict on MELI, or is it a verdict on MayTech's own portfolio structure? Let's start with the cold, hard numbers.
Well, let's do it.
So, according to their SEC filing, this was dated November 12, 2025, it reported that MayTech sold 11,148 shares of MercadoLibre.
Just during the third quarter.
That's the precise number they moved.
And, 1148 shares might not sound like a huge number,
No.
but you have to quantify it. That sale was a net position reduction of an estimated $2.7 million.
Okay, so that's a decent chunk of change.
It is. But what's vital here is the context. After that small trim, the fund still holds 25,081 shares.
Wow.
So that remaining stake, it had a market value of $58.6 million at the end of the quarter.
So they took $2.7 million off the table, but they kept nearly $60 million in the game.
Precisely.
And here's where I think a little bit of tension comes into the story.
Yeah.
Around the time of that filing, MELI shares were priced at what? Around $2,100?
Roughly, yeah. $2,099.57 on November 11th, to be exact.
Okay. And while the stock was up 7% over the past year, it was actually underperforming the S&P 500.
By 2 percentage points.
Now, for a growth fund, that kind of underperformance, even if it's slight, it might raise an eyebrow.
It absolutely raises an eyebrow, and that forces us to look deeper than just that one transaction.
Why trim a position that's lagging a bit, especially one you've held for so long?
Right. And this is where we need to look at the portfolio's center of gravity.
Which brings us to a really critical concept, assets under management percentage, AUM. This tells us not just what they own, but how important each piece is to the whole fund.
Exactly. And when we analyze the filing, that's where the real story is. MercadoLibre's position dropped from 7.0% of MayTech's total AUM in the prior quarter, down to 6.1% after this sale.
So that drop is the real headline here.
It is. It wasn't a sudden panic sell-off. It was a calibrated reduction. It was designed to bring the position back into a specific alignment.
Let's pivot then to the broader view of MayTech's strategy. This fund has a really clearly defined mandate, and you can see it in their top 5 holdings. I think you, the listener, need to know who MELI is sitting next to at the table.
It tells you everything.
It really does. It shows MayTech is a high-conviction growth fund. Look at these numbers. Number 1 is NVIDIA. It's a massive 19.7% of their AUM.
Almost a fifth of the entire fund.
Then you have Alphabet at 10.0%, Meta Platforms at 9.2%, and Amazon at 6.7%.
All the heavy hitters.
And then rounding out that top 5 is MercadoLibre at 6.1%.
What I take away from that is their entire philosophy is just. It's centered on mega cap growth and market domination. When NVIDIA takes up almost 20% of your fund, that kind of dictates everything else.
Right.
So that makes the 6.1% ELI position, even though it's $58 million stake, look, comparatively smaller in the grand scheme.
That's a great point. And they've held MELI for a while, haven't they?
Well, what's fascinating here is that MayTech has held MercadoLibre since 2017.
Wow. So they are long-term believers.
Absolutely. So when you see a small trim after 8 years of holding, analysts generally conclude, and I think we agree, that this is likely not a fundamental worry about the company's future.
So, okay, if they weren't worried about the future of MercadoLibre, why sell? Couldn't they have trimmed Amazon or taken some chips off that massive NVIDIA position?
That's the critical question, isn't it? And the answer is likely that MELI was A victim of its own success.
A victim of its own success. What do you mean by that?
Well, you see, sometimes a stock performs so well that it just organically grows beyond the risk parameters a fund manager sets.
So it gets too big for its slot in the portfolio.
Exactly. We saw the MELI position had previously soared. Due mostly to the stock's rising price, it jumped from just 4.8% of the firm's portfolio in early 2024,
Right.
all the way up to 7.0% by the last quarter.
That's a big jump.
It's huge. That 2.2-point increase is what we call portfolio drift. So this recent small sale was almost certainly just technical rebalancing.
So just housekeeping, basically.
It's standard procedure. You bring the position back to its target weight, you raise some cash, you maintain your diversification mandates. It doesn't signal a loss of faith. That's like cleaning out your closet. You get rid of things that have outgrown their spot, even if you still love them.
That makes perfect sense. So it's a portfolio-level decision, not a company-level indictment. Let's shift our focus now to that company, the one MayTech still trusts with $58 million. For anyone who hasn't been following its rocket trajectory, who is MercadoLibre?
MercadoLibre is the leading Latin American e-commerce and fintech platform. What makes them so powerful is that they're not just, an Amazon equivalent. They are an integrated solution provider. They effectively built the infrastructure for commerce in huge parts of the continent.
And it's that ecosystem that's so key. It's not just selling goods online.
Yeah.
It's this sort of triple threat model.
It truly is. Their competitive advantage, what we call their moat, is that integrated ecosystem.
Okay.
So you have the core e-commerce platforms, obviously, but then tied directly to that, you have Mercado Pago.
Their digital payments arm.
Right, their digital payments and financial services arm. And this has been revolutionary in areas where traditional banking penetration is low.
And then there's the third piece.
Mercado Envios, their logistics network. You have to understand, in many of these developing markets, just getting a package from point A to point B reliably is a massive operational hurdle.
And MELI solved it themselves.
They did, and then they build on top of that with credit, investment products, advertising. They control the sale, the payment, and the delivery.
It's an incredibly sticky loop for merchants and consumers.
It is, and that control over the entire transaction is why they're so valuable.
And that engine, it must generate serious revenue.
Oh, through every single step of that process, transaction fees, payment processing, logistics fees, all their financial products. It's a massive, multifaceted business model for an entire continent.
Let's talk numbers on the company itself.
If we look at their performance over the past year, the scale is just staggering. We're talking about a market cap of $106.7 billion.
Wow.
Their revenue over the last 12 months is at $26.2 billion. Generating a net income of $2.1 billion.
This isn't some fragile tech startup.
No, this is a foundational engine powering huge parts of Latin American commerce.
And here's where it gets really interesting when we talk about the growth thesis. Despite its huge size today, MELI's history has been defined by explosive returns.
I mean, since its IPO in 2007, it's been a 76-bagger.
76 times its initial price. That is just a staggering track record.
And what justifies MayTech keeping that huge $58 million position, even after trimming, is the sustained growth.
Right.
The company continues to grow its sales by more than 35% annually.
And that's not just a historical figure.
No. That rate holds true over the last year, the last 5 years, and the last 10 years. That kind of consistency, especially in massive, sometimes volatile emerging markets, is what portfolio managers prize above almost anything else.
But we have to tackle the valuation head on.
You do.
With that kind of growth, the price is, understandably premium. It's trading at 50 times forward earnings. We have to acknowledge that's high. It is definitely not classically cheap.
No, it's not. But you could argue that if any company deserves a premium valuation, it's one delivering consistent 35+% growth in a market that still has immense headroom.
And this is where that critical thinking comes in.
It's essential. You contrast that tiny MayTech sale, which we've pretty much established was likely just rebalancing, with the fact that the stock is currently trading about 20% below its all-time high.
So there's a disconnect there.
There is. And given its leadership advantage and the strength of that ecosystem, that high PE starts to look justified by the sheer scale of the potential market.
What I take away from that is something David Gardner often talked about.
The trim my flowers and water my weeds idea.
Exactly. Don't do that. And the argument here is that MercadoLibre, this proven winner with a massive advantage, it actually makes for an interesting buy-the-dip candidate right now.
Especially when you compare it to that slight index underperformance we mentioned earlier.
Instead of a position to trim.
It's true. The 13F filing gave us the trigger, But the deep dive into the portfolio context gave us the answer.
The sale was a technical adjustment.
Of a highly successful long-term holding, that $2.7 million trim was made necessary by the stock's own outsized success, forcing MayTech to rebalance its risk profile.
Not because of a sudden concern about a $106 billion business.
A business growing revenue by over 35% a year.
So we've come full circle. Analyzing these institutional filings, these 13 Fs, it's all about context.
Fundamentally.
You look at that tiny fraction sold, and you realize the context, that massive NVIDIA position, the long-term holding period, the portfolio drift, it all points away from fundamental concern.
And towards just sophisticated portfolio management.
And for you, the learner, what's the takeaway here?
I think when you examine high-growth stocks like MELI, stocks that trade at high multiples like 50 times earnings, the true indicator of a company's health, it doesn't often lie in these short-term portfolio shifts by a single fund.
Right.
It lies in its sustained high revenue growth rates, those consistent 35% annual increases, and its unique integrated competitive advantages, that powerful moat. Those are the factors that justify the valuation premium.
So here's a final provocative thought for you to consider. If a fund trims a position because of its own success, and that same position is still trading 20% off its all-time high, how much growth optionality? Things like expanding those fintech and logistics services even deeper into new territories. How much of that is already priced into the stock? And is that current price still a gift if the company can keep up that 35% growth rate for the next 5 years?
Something to chew on.
Definitely something to chew on until the next quarter's filings give us the next piece of the puzzle. We hope you enjoyed this deep dive. We'll see you next time.